The Mortgage Minute today being brought to you by our friends at Geneva Financial when you're ready for that next home loan. Geneva's got the programs and the products. You just need to make the call. 800-306-1990, 800-306-1990. Every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry. They don't tell us points paid, points received, or APR, but they tell us the rates calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. Let's see what they locked at yesterday. 30-year conforming, 6.831. Jumbo, 7.34. FHA, 6.638. USDA, 6.786. That's the rural areas. Generally no down payment. 30-year VA loans. That's the best loan on the market. 6.524. Now, I told you that, well, I'll get into that in a minute. I better wait for the I told you so. But I do want to remind you, every morning as early as the data allows, we do send out our thoughts and commentary on the mortgage market, rsrmarketminute.com, rsrmarketminute.com. You can go right there, register to get on the mailing list. It is free to you. But that data is all from yesterday's information. Let's take a look at what's going on today. So we do have the S&P 500 is up 11 points. Dow's up 190, mainly on the back or the heels of Goldman Sachs, JP Morgan, and one other that came out with some good numbers, and their stocks are up. The 10-year Treasury, that one is down 2 basis points, 4.24 right now. Mortgage-backed securities are up 18 basis points. Remember, when the bond goes up, rates go down. And I shared this with you, I think it was Tuesday, when the market was tanking following the CPI report. And the CPI report wasn't that bad. I mean, basically, the markets expected the inflation to drop a little bit more than it did. Inflation went down, but the market expected it to go down a little bit more. And I said to you, the only thing I ever guarantee on Ron Siegel Radio is that the markets will always, always, always overreact. And sure enough, the markets overreacted. The bonds went down a lot. Rates went up a lot on Tuesday following that report. Recovered some yesterday. They're recovering some today. But today we also got retail sales for the month of January reported at a negative 0.8%, which was much worse than the negative 0.1 expected. Even when stripping out automobile sales were a negative 0.6. Core retail sales were negative 0.4, which was also much worse than estimates of a 0.2% gain. Year over year, they're up 2.5%, which is the slowest pace since 2019 when you remove the unicorn years of COVID. We thought we would see the consumers spend less in January. We broke it down earlier this week, talking about the idea that the consumers are out of money. They don't have the money to do anything. They've tapped out all their credit cards. Now they've gone to this buy now, pay later, which costs the consumer double what it would cost on a 30% credit card, maybe even more than that. And the consumers are finally saying, you know something, I got to pay my bills. They are not the federal government who just keeps on spending more money. So that might lead us into some other problems that are down the road. Initial jobless claims measures individuals filing unemployment benefits for the very first time, fell 8,000 to 212,000. Continuing claims are those that continue to receive benefits after their initial claim, rose 30,000 to 1.895 million. This figure is the second highest reading since November 2021 and shows that once people are laid off, they're having a hard time finding a job. Industrial production and capacity utilization in January fell 0.1%, which was lower than the 0.3 expected. And finally, weakness in Europe. Japan released their Q4 GDP figures, which were negative for the second quarter in a row. This historically would mean that Japan is in a recession. We also saw some weakness out of Europe, showing that we're seeing some global economic weakness. Do you think we're going to be immune? I doubt it. But we've been telling you that right along. Q2, we will be in the recession, my opinion. The rest of the country will catch up to the 4.8% unemployment rate we have in California. And we do know that mortgage rates drop as we see when we go into a recession. Real estate values will increase as we go into a recession. I know it sounds counterintuitive, but real estate values will go up. Dave, what do you think? They always do, or historically they do, basically because interest rates are dropping, more people start wanting to buy or can afford to buy. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990.